Welcome to my channel. I am going to walk you through the process of valuing 5 resorts and casino stocks and analyzing their financial ratios. Become a member of the channel for as little as 99 cents or up to $99. We could also do a private Zoom session to discuss financial statements. The first company is Caesars Entertainment. This is a mid-cap company, 9.4 billion market cap. They're trading at $54.49 and they have 173 million shares outstanding. To get shares outstanding, that's market cap divided by stock price gives you shares outstanding. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that number back to today's value. That's what we're doing in this video. Free cash flow is cash flow from operations minus capital expenditures. So if a company has positive free cash flow, they can pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. If a company has positive free cash flow, that means it's generating more cash than it's spending. This company has positive free cash flow each year, so that looks really good. Their net income also looks positive and fairly consistent, and their revenue grows a lot from 2016 to 2019, so the financials look pretty good. Let's look at a capital structure. They have $2.6 billion of debt. They pay 11% interest on their debt, and the cost of debt is 7.22%. To get cost of debt, that's interest rate times 1 minus the effective tax rate. And they have a lot of debt in their capital structure. They're 70% debt, which means they have 30% equity. Cost of equity is 25%. And to figure out cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. And their beta is almost 3, so that means the stock moves 3 times the market. So it's a really volatile stock. The higher the beta, the higher the cost of equity. And their WACC is about 12.5%. which is a blend of the cost of debt and cost of equity. So when a company wants to take on a new project or a new venture, they look at the cost of that project and then estimate the future cash flows. And then they discount those cash flows back to today using the weighted average cost of capital. Then they're able to see whether that project will add value to the company or not. The WACC is a discount rate we're going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.5 billion. We divide that by 173 million shares. And we get a calculated stock price of $32. They're trading at $54, so they're trading at a 70% premium. It's a strong sell according to the model. I'm at $32. Simply Wall Street's at $96. So they're expecting this company to have really major growth in the next few years to hit this $96 number. Let's see where the stock has been trading at the past few years. The stock peaked about $70 before the coronavirus crash, and it came way down there, but it's come up quite a bit since the bottom. It's really hard to predict how well this stock's going to play out, depending on how many people go back to the casinos or not. Let's look at the financial ratios. They don't have a good PE. The median for the entire market is 16.6, the average is 18.7. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 116. That means investors are paying $116 for $1 of earnings. Price of sales is a little high as well. The median is 2.0. The average is 4.7. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 3.7, so investors are paying $3.70 for $1 revenue. Price to book is a bit high as well. The median is 2.3, the average is 4.9. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 8.4. So investors are paying $8.40 for $1 of book value. Equity is total assets minus total liabilities on the balance sheet. Interest coverage ratio is a bit low. The median is 4.0, the average is 13.3. Interest coverage ratio is EBIT over interest expense. They're only at 1.6. I like to see above 2.0. EBIT is earnings before interest and taxes. It's on the income statement. It's called operating income. ROE is also low. The median is 12%. The average is 15%. ROE is net income over equity. I like to see above 20%. They're only at 7%. Current ratio is a bit low. The median is 1.3. The average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 0.9. The best way to look at ratios is to compare them to similar companies. I've done videos on Boyd, Eldorado, Golden, Las Vegas Sands, MGM, Vail, Penn Gaming, Red Rock, and Wynn, all in the same industry as Caesars. And if Caesars has a number in red, they're worse than the average. If they have a number in green, they're better than the average. A lot worse in PE, worse in price to sales, a lot worse in price to book, a bit worse in current ratio, a bit worse in ROE. They have a little less debt than the average. They're still high at 70%, but the average is 72%. They're a little bigger than average in market cap at $9.4 billion, and they don't pay a dividend like most in this industry. So to summarize, I have them trading at a 70% premium. Their ratios are a bit weak, but their financials look okay. The next company we're going to look at is Las Vegas Sands. They have a market cap of $36 billion, so they're a big, large cap company. They're trading at $46.72, and they have 779 million shares outstanding. Their free cash flow looks really strong, $2.5 billion to $1.7 billion. It does go down, but still, it's a lot of free cash flow. Net income also looks really high and strong, and their revenue looks pretty good. It's growing a little bit each year. It doesn't grow too much from 2018 to 2019. And the margins look healthy. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. They convert about 20% of their revenue to profit. That means they're doing a good job managing their expenses. They have $12.5 billion of debt. They pay 4.4% interest on their debt, and cost of debt is 3.9%. They're also a bit leveraged at 71% debt. So they're 29% equity. Cost of equity is 14.15%, and we need the beta to figure that out. The beta is 1.54, so the stock moves about 1.5 times the market. The WACC is 6.9%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $41 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $46 billion. We divide that by 779 million shares. And we get a calculated stock price of $59. They're trading at $47, so they're trading at a 21% discount. It's a buy according to the model. I'm at $59, Simply Wall Street at $68, so they're saying the stock is even more undervalued. Let's see where the stock has been trading at the past few years. It peaked in the low 70s a couple of years ago, but it's coming down a lot, and it hasn't come up at all since the bottom. So it looks like it could be a really good value, assuming things go well for this company. Let's look at the financial ratios. Really good PE, a pretty good price to sales, and a weak price to book. PE is stock price over earnings per share. They're at 13.5. This is the median for the market, and this is the average for the market. Price to sales is stock price over sales per share. They're at 2.6. That's pretty good. Price to book is stock price over book value per share. They're at 7.0. Good interest coverage ratio, that's EBIT over interest expense. They're at 6.8. They can easily cover their interest payments. Great ROE, that's net income over equity. They're at 52%, much better than the median and average in the market. Current ratio is also really good. That's current assets over current liabilities. They're at 1.6. The best way to look at ratios is to compare them to similar companies. I've done videos on 9 other gaming casino stocks, and Las Vegas Sands is here in the middle. If they have a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are much better in PE. They're a little worse in price to sales, a lot worse in price to book. They have the highest current ratio of the bunch. They also have the highest ROE. Their debt is about average. It tends to be safer to invest in a large company because they have more capital to get through difficult times. To summarize, I have them trading at 21% discount. Their ratios look pretty good and their financials look really good. The next company we're going to look at is Vail Resorts. They have a market cap of $9 billion. They're trading at $2.14 a share and they have 42 million shares outstanding. Free cash flow looks pretty good. It's pretty consistent year to year. Net income also looks pretty good. It's a little low in 2019, but it's positive. And their revenue is steady. It's not really increasing. They have $2.5 billion of debt. They pay 4.35% interest on their debt, and cost of debt is 3.5%. They have 65% debt in their capital structure, which means they have 35% equity. Cost of equity is 11.9%. And we need the beta to figure that out. Their beta is 1.25, so the stock moves a little more than the market. Their WACC is 6.5%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $3.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.4 billion. We divide that by 42 million shares. We get a calculated stock price of 105. They're trading at 214, so they're trading at a 105% premium. It's a really strong sell according to the model. Simply Wall Street's only at $45 a share, so they're saying the stock is really overvalued. Let's see where the stock has been trading the past few years. So the stock peaked about 280 a couple of years ago, then took a dip at coronavirus. It's come back up for the most part. It's still way below its all-time high. So it looks like it could be a really overvalued stock, but you don't know about these things. If people keep buying the stock, even if it's not worth it, it will go up the price. Let's look at the financial ratios. They don't have a good PE, price to sales, or price to book. PE is stock price over earnings per share. They're at 91. Price to sales is stock price over sales per share. They're at 4.6. Price to book is stock price over book value per share. They're at 6.8. Interest coverage ratio is pretty good. That's EBIT over interest expense. They're at 2.3. ROE is a little low. That's net income over equity. They're at 8%. Current ratio is good. That's current assets over current liabilities. They're at 1.1, so they can cover their current debts and payables. The best way to look at ratios is to compare them to similar companies. I've done videos on 9 other resort and casino stocks, and Vail is here in the middle. If they have a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are worse in PE, price to sales, price to book. They're doing fine in current ratio, a little worse in ROE. They have a lot of debt, but the average in the industry is so high, so they're lower than the average. They're a little higher than average in market cap, and they don't pay a dividend. So to summarize, I have them trading at 105% premium. Their ratios don't look so great, but their financials look okay. The next company is Red Rock Resorts. They have a market cap of $2.1 billion. They're trading at $16.68, and they have 126 million shares outstanding. Free cash flow doesn't look so great. They're positive in 2 years, negative in 2 years, so they're leaking a lot of cash. Net income looks okay, but they did have a negative in 2019. It looks like it was a bad year. But they did have the highest revenue in 2019 at $1.9 billion. Their revenue goes up each year. They just spent a lot that year, so they had negative net income. They have $3 billion of debt. They pay 5.17% interest on their debt. Cost of debt is 4.66%. They're really leveraged at 86% debt, which means they have 14% equity. Cost of equity is 24%. And they have a really high beta, 2.81, so the stock moves almost 3 times the market. So it's really volatile. Their WACC is 7.38%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for. That's $1.4 billion. We discounted these numbers back to today using the weighted average cost of capital. We get a value of the company at $2 billion. We divide that by 126 million shares. We get a calculated stock price of $16.33. They're trading at $16.68, so they're almost trading exactly where I calculated stock price. Let's see what Simply Wall Street says. They're at $21.40, so they're saying the stock is undervalued. Let's see where the stock has been trading the past few years. So the stock broke through 30 a couple of times, but it's at a pretty low point. So it looks like it could be a good value. You just might have to wait a year or two to see the returns. Let's look at the financial ratios. Negative PE because they have negative net income. Really good price to sales, that stock price over sales per share, they're at 1.1, a lot better than the average and the median. Price to book is okay, that stock price over book value per share, they're at 4.2. Interest coverage ratio is a little low, that's EBIT over interest expense, they're only at 1.7. They don't have that much room after they pay their interest payments. ROE is negative since they have negative net income. Current ratio is okay, that's current assets over current liabilities, so they can just cover their current liabilities. The best way to look at ratios is to compare them to similar companies. I've done videos on 9 other resort and casino companies, and Red Rock is here at the end. If they have a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are, of course, worse in PE. They're doing well in price to sales ratio. Price to book, they're a little worse. Current ratio, they're also a little worse. ROE and debt and market cap, they're a lot worse. Red Rock is only one of 2 companies in this industry that pays a dividend, and they by far pay the highest, a 4% dividend yield. So to summarize, I have them trading at a 2% premium. Their ratios look a bit weak, but they do pay a high dividend. But their financials also look weak. The last company we're going to look at is Wynn Resorts, another resorts and casino company in Las Vegas. 7.9 billion market cap. They're trading at $71 a share, and they have 111 million shares outstanding. Free cash flow looks really bad. It's negative in 3 of the 4 years, so they're spending a lot more cash than they're generating. Net income is positive in all the years, but net income is more of an accounting number where you can manipulate it a little bit. Free cash flow is actual cash. Revenue looks pretty good. It goes from $4.5 billion to $6.5 billion. They have $10.4 billion of debt. They pay 4% interest on their debt, and cost of debt is 2.5%. They have 86% debt in their capital structure, so they're really leveraged, which means they have 14% equity. Cost of equity is 20.6%, and their beta is pretty high, 2.38, so the stock moves more than 2 times the market. Their WACC is 5.13%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $1.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 111 million shares. And we get a calculated stock price of $16. They're trading at $71, so they're trading at a 357% premium. It's a really strong sell according to the model. Simply Wall Street has them at $19, so they're also saying the stock is overvalued. It's really hard to value a company with so many negative free cash flows, so I had to use a really conservative model just to come up with a value. Let's see where the stock has been trading the past few years. So the stock price has broken through 180, but it keeps coming down, and it might keep coming down more if investors feel the same way as I do or the same way as Simply Wall Street does. Let's look at the financial ratios. Bad PE, good price to sales, and a weak price to book. PE is stock price over earnings per share, they're at 64. Price to sales is stock price over sales per share, they're at 1.2. Much better than the median and average. Price to book is stock price over book value per share, they're at 4.5. Interest coverage ratio is okay, that's EBIT over interest expense, they're at 2.2. ROE is a little low, that's net income over equity, they're at 7%. Current ratio is really good, that's current assets over current liabilities, they're at 1.4. The best way to look at ratios is to compare them to similar companies. I've done videos on 9 other resort and casino companies, and Wynn is here at the very end. And if Wynn has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are much worse in PE. They're better in price to sales, a little worse in price to book. They're doing great in current ratio, worse in ROE, debt, a little lower market cap, and they don't pay a dividend. So to summarize, I have them trading at a really big premium. The ratios look pretty weak, and the financials look pretty weak as well. So let me know what you think of the video. Leave a comment. I reply to everyone's comment, and become a member of the channel for as little as 99 cents up to $99. Thanks for watching.